Sheila Bair, your book, Bull by the Horns, recounts your days as the FDIC chairman during the financial crisis. Before we go too much further, what I and a lot of people want to know right now is our banking system safe?
Yes. Well, it's certainly safer than it was leading up to the crisis. And of course, if you have your deposits below the insured deposit limits, you're completely safe. But yeah, it is safer, but we still have a long ways to go before we have a truly stable system.
Now, the FDIC is not as glamorous as Treasury
Right.
or the Federal Reserve.
Right.
So do you think it gained a measure of respect by doing what it did in protecting people's deposits throughout the financial crisis?
I do. I absolutely do. You know, people ask me, what's your proudest accomplishment during the crisis? And it was just that, making sure that people's money was safe when their banks failed. Not only was it fully protected, but we guaranteed seamless access to your money. So you never had interrupted access to your checking account or your savings account. And that was very important. I mean, those are pretty frightening times, and people needed to have confidence in something. And I think, you know, they kept faith in the FDIC, and we worked very hard to keep that faith. So I'm very proud of that.
And we really never saw the run on the banks that a lot of people were fearing.
No. There were runs on what they call the wholesale markets, the commercial paper market, the capital markets. Vehicles for funding, but insured deposits stayed quite stable, and that did save the system, because if people started taking their deposits out of the banks, it would have been over. It really would have been.
Well, throughout the crisis, as you describe in your book, a lot of the Wall Street CEOs certainly didn't have much respect for the FDIC. They kind of considered a lesser vehicle for the government to regulate.
Was some of that,
now, do you think that they've been sufficiently humbled and they know a little bit more about the FDIC and will give it a little bit more credence maybe the next time? Hopefully the next time won't come. But if it does, they know that the FDIC is a very strong branch.
Yes. I do think we earned their respect, and not perhaps we're popular with them, and me personally, I'm probably not popular with them, but I do think they respect me and the institution. Yes, I do. We earned that. We did, but they had to turn to us. When other sources of funding dried up for them, they had to turn to us, and we temporarily backed their debt. We charged a fee for it. But we did it, and we kept them so they had the position that they could raise enough funds to continue their operations, which was very important during the crisis.
And a lot of them needed you desperately.
They did need us, yes, they did.
And
yes.
One of the things that was a thread throughout the book is that Tim Geithner was, to a certain extent, your nemesis. He was the Moriarty to your Holmes, if you will. And one of the things that he did throughout the crisis is he matched up weak and strong banks. So you'd have Bear Stearns would fall, so we'd bring it over to JP Morgan. Same thing with WAMU. Now, to a certain extent, that's made the too big to fail banks even bigger post-crisis. Do we need to break them up now, and is that even possible?
Well, actually, we were the ones that did the WAMU sale to JP Morgan Chase, and that was part of a competitive auction process. We had a very sick institution with WAMU. We tried for a while to deal with it by alternative means, but it did fail. We needed to, the best option we had was to sell it. And JP Morgan Chase was by far the highest bidder in our process. With me, and yes, I do talk about that in my book, because people say, well, didn't you just make the banks bigger? With me, it's more complexity than size. And a bank that takes deposits and makes loans, and that's basically what WAMU did. They made bad loans, but that was a fairly straightforward business model, and their management and their regulator were not on top of the situation. But we didn't really add to the complexity of JP Morgan Chase by selling them what was inherently a traditional bank franchise with some very bad loans, grant you. So I think where you run into too big to fail problems is when you have these mega institutions that combine traditional banking with derivatives market making, with securities market making, sometimes with insurance, a lot of structured finance. That is when you start getting institutions that are too complex to manage, too complex to supervise, and ones that really do pose a broader threat to the system because they're just so big and they're so interconnected. The interconnectedness is really a problem. That's when you get into these too big to fail issues.
Would you consider Citigroup one of those banks right now? Because you were pretty harsh when it comes to their CEO, Vikram Pandey.
Right. Well, I am, and I do think that he may be very talented in certain areas, but his resume is not one that would suggest that he's qualified to run one of the world's biggest commercial banks. And I do think that deposit insurance in particular should be used for traditional banking activities. They want to do higher risk securities and derivatives trading. That should be firewalled off and put in other parts of the institution. I also think it requires quite extraordinary management to be able to stay on top of these very large institutions, and even Chase, which by all external indicators suggest is the best managed of the mega banks, the London whale trades, they missed it. Jamie Dimon missed it. So I think it just underscores the fact that even the very good experienced management has a very difficult time of managing a sprawling institution that is complex in a lot of different business lines, especially highly volatile, risky trading and derivatives activities.